appreciate that. Thank you. I'm so excited to be here. I'm going to talk to you about my bulletproof wealth strategy, and it is how to turn your wealth into a tank. So as Isabella said, I was in the music industry for 29 years. This is a picture of me working with a band called REM. There's me sitting right there. So it was in the late 80s, and it was really fun. This record was called Green. It was one of the really good records, and I was so fortunate to get to work in that industry for a long time. And I got to work with some amazing artists like Bruce Springsteen, Mavis Staples, the Fabulous Thunderbirds. While I was in the music industry, something really unfortunate happened. And I was standing there in my office, and my financial advisor rang the doorbell, and I went to open the door, and he had this very troubled look on his face. And of course, I invited him in to see what was going on, and he started crying immediately and begging me not to turn him into the authorities. So I knew it was really bad, okay? And basically, he was defrauding me and using my money for his own financial gain. This wasn't the first time, the second time, the third time. This was actually the fourth financial advisor that had defrauded me and used my money and told me things that weren't right, and it was just a terrible situation. And 2 out of 3 of those guys ended up in jail, and the third one should have as well. And I wanted to do something about it. So 10 years ago, I decided, hey, I am going to make this career change. And I had this partial hearing loss and wasn't able to keep working, but I did have a long-term own occupation disability policy that paid for me to go back to school and earn a bunch of financial designations so that I could really help people not make the same mistakes that I personally made. And then I was listening one day, and I heard a podcast talking about saving money in life insurance. I decided to try it myself, and it not only met my expectations, but it exceeded them. So guys, I want you to know that I believe your money should be working in at least 3 places at the same time. So there's the standard American plan, right? This is just what average normal people do. And I'm going to compare and contrast, first of all, what the average plan is versus the bulletproof wealth system. So standard American plan is where you give up control, right? You hand your money over to somebody else. This is what I was doing in the music industry, was giving up control to somebody else to hopefully manage my money. And, you know, I call it smoking hopium, right? Because you're just hoping they know what they're doing, but you really have no idea. Also, you have zero protection. So there's no protection against downside risk. And there's a large amount of market volatility that you inadvertently expose yourself to doing the standard American system. And there's an uncertain future. There's so many people that get to retirement age, they have no idea if they're going to run out of money in retirement or not. It is absolutely sad, and there is a way to avoid this. And they rely on banks. There's so many people that rely on banks to, can you please give me a loan? You know, can I please get financing for this? And the bank has all the power and the person has none. And so that is not good. And finally, your money's only working at one place at a time. So obviously, there's a better system out there, and that's why I went back to school, spent 4 years going through and got multiple different financial degrees. I'm a chartered life underwriter, a chartered special needs consultant, a chartered financial consultant, and I'm just about finished with a retirement income planning specialist designation. So I really spent a lot of time trying to figure out, get super educated on how I can help people to do something different. And I do this thing called the Bulletproof Wealth System, and it allows you to keep control of your financial future, number one, maximize your protection, your wealth compounds every year, and you have a tax-free retirement that is kind of designed and built into this strategy. And I'm going to show you real deep dive how this actually works. It creates a privatized bank for you, and your money works at 3 places at once. And you might be going, now how in the world can your money be working at 3 places at once? Well, to understand that, you need to understand what collateral is. And I know that a lot of people in this room, there's a lot of sophisticated financial people, but I'm going to break it down to make this simple because I really want you to know how this works. So collateral, what is it? Well, it's an asset that a lender accepts as security for a loan, okay? That is what collateral is. And obviously, everything has a certain collateral capacity. That means how much money are you going to be able to access off of this asset, all right? And if you look at the collateral capacity of different asset classes, you can see that most of them hover around 50%. So if you have a stock portfolio, for example, you would be able to get about a 50% collateralized loan borrowing against that stock portfolio, okay? And it's important to know why that is. So if you had $200,000, for example, of stocks as your asset, and you wanted to keep your stocks but pledge that asset as security for a loan, well, they're not going to give you a $200,000 loan because the actual portfolio is highly volatile. So it might cause the bank or whoever's giving you the loan to go underwater. So that is why stocks have about a 50% collateral capacity. And the same with diamonds and jewelry, right? You can pledge these things, but they give a small percentage on how much you can actually use as security for a loan. And precious metals, same thing. You can pledge gold and silver, keep it, and have about a 50% collateral capacity. And even crypto, you can do this with as well. So with Bitcoin and other different cryptocurrencies. As you guys probably are aware, one of the higher collateral capacity vehicles out there is investment real estate. So if you have an investment house, for example, you can get about a 75% collateral against that house. So just to make this super simple, if you had a house worth $1 million that was fully paid off and it was an investment property, you could get like a home equity line of credit on that for about $750,000. Somewhere in that vicinity, right? It's a little higher if it's your personal residence, but I would not recommend, risking your personal residence to get collateral. So what out of everything that I have researched and found and all of the studies that I've done, the best collateral that I have ever been able to find, believe it or not, is this what I call bulletproof collateral. And this is the cash value of life insurance, which can have up to 100% collateral capacity. So it actually is a really cool vehicle for many different things, asset protection included and retirement income planning. So I kind of want to break it down for you guys and make it super simple to understand by relating life insurance to a tank. And so on this tank, the first thing that it has are traction for unstoppable growth, and those are the treads, right? And what this is, it's uninterrupted internal growth that happens from the moment you start putting money into it. It's tax advantaged. It's important that you guys understand what the tax advantages are, because a lot of people say, oh, it's tax-free, it's tax-free. It's not really tax-free. It is tax advantaged, meaning that you can extract your basis or how much money you put into life insurance out without having to pay tax, because it's based on a first in, first out taxation basis, as opposed to last in, first out, which is how pretty much every other financial instrument is taxed. So just to break that down and make it super simple for you guys, if you put $100,000 into a stock portfolio and it grows to 200,000, and then you decide you want to pull 100,000 out, that's all going to be taxed as capital gains tax, right? But if you had $100,000 in cash value in a life insurance policy, and then it grew to $200,000, If you pulled $100,000 out, that would be considered your first money in or your basis. So there would be zero tax consequences, which that's super powerful. And I'm going to show you how that works later with an example. So the actual growth of the money compounds, and that is critically important that you never go backwards. And that's the kind of another great thing I like about the treads on a tank is these tanks move forward, they don't go backwards. So let's just say if you were compounding at a 5% interest rate and you had $100,000, then at the end of 12 months, you'd have $105,000. Now the next 12 months, it's gonna earn 5% on $105,000. So it's going to continue to grow on top of the growth, and that is really the most amazing thing over the long run. If you can get your money in a place that it's growing all the time, you will be so far ahead of the game later. So the second thing on the tank is the armor. And that armor provides safety and security. And what is the deal with the armor? Well, it has zero market volatility, and it also has asset protection from creditors and predators. Now, this varies on a state-by-state basis because the asset protection is regulated, or life insurance is regulated by the state. And so some states have amazing asset protection and some is not as good, but there's a lot of states that it's 100% of the cash value in your policies is completely and totally asset protected. So they can't be attached by a bankruptcy or something like that. They can't be attached by creditors. For example, Florida, Utah, Tennessee, Texas, a lot of the states that I do a lot of business in is 100% asset protected. Another feature on this tank that is super important that I relate this concept to is the turret. And the turret has built-in funding flexibility. That means it can pivot, right? So that means that you have the ability to put in a wide variety of different amounts each year, and it also creates goals. I have 10 of these policies now. I've been doing it for 10 years, so I've been just building them up over time, and I definitely do my own strategy. I think that it's super important that anybody that you're going to work with is actually doing what they're talking about with other people. And I noticed that if I have the ability to put in, let's just say, $75,000 if I want to in a policy in 1 year, but I only have to put in $37,500, that it gives me this goal to shoot for because I know on a certain date, I'm gonna have an amount of money that I can drop into that policy. And if I don't hit the goal, then I can hit the minimum, right? But it just gives you a goal to shoot for so that you can start planning your savings. And that is critically important. So the policies have an annual minimum and an annual maximum, and it allows you to just fund it flexibly on your policy anniversary. And the other cool thing is there's a catch-up provision for shortfalls. That means if you guys don't hit your goal, then you have a whole year the next year to make up the lack of it from the last year. The other thing is that there's a fuel reserve on this tank, and that is basically an add-on that I put on as many policies as I possibly can get it on that pays the minimum if you're sick or hurt and can't work. And that is super important because there's a maximum and a minimum. The maximum is just what you're hoping to put in and what most people do. They hit the maximum, but the minimum is critical because you have to put that in. And this add-on that I do pays for that minimum if you can't pay it yourself. And it also provides money to meet needs during chronic illness or terminal illness. It's not a long-term care policy, but it functions very similar to a long-term care policy in that it uses the same triggers. 2 of the 6 activities of daily living are the triggers that would actually pay for you to be in a long-term care facility. You're getting the benefit without having to pay for it, and you only use it if you need it. So the next thing on this tank that is really something that I've identified that is super important is the escape hatch, right? And that is the permission to spend money, right? And that is, hey, you got a tax-free retirement income and a tax-free legacy. And this is absolutely huge that it can provide this for you. And probably the most important thing, because a tank would be just terrible if it didn't have this, is the big gun, which is the line of credit. Okay, so there's a line of credit that gets established right away that you can use within the first 30 days. And that line of credit increases annually, and it has guaranteed access, and there are no fees. All right, there's 0 fees to access this line of credit. It increases every year. You have a guarantee, and then finally 5-day liquidity, which means that if you put in a request for a loan, you usually can get that loan money deposited in your account within 5 days. And there's no required interest payments, which a lot of people that I work with do, for example, wholesaling, and they do fix and flip and those kind of things. And it really works amazing for that kind of a real estate investor as well, because they don't have to pay the interest. It's not required on the loans until they fund their fix and flip deal. It's not exactly a good idea to not pay interest because you're going to have it accrue, but it's not required, so you just pay it when the property sells. So what are some of the targets that this big gun shoots at? Well, it's really important to know you can do pretty much anything, but a lot of my clients, including myself, use it for private lending, which means that if you have somebody that needs money and is willing to pay a higher interest rate than you're being charged by the insurance company, it can be a phenomenal way to arbitrage that interest rate and to make money like banks do. That's the whole point of why you would do this. Another thing you can use it for that a lot of people don't think about is down payments. So if you're buying a property, let's say you have acquired or you have got your sights on a residential assisted living facility and you need $200,000 for a down payment and you're going to finance the rest. Well, if you have that money sitting in your policy, you can use that as a down payment even though you're borrowing it. And the reason is because there's no required interest repayment on that. So it works really well for down payments. And of course, you can use it for other things. I just threw some stuff up here that you might use it for. Remodeling and rehabbing is a great thing to use it for. Maintenance fees, maintenance costs. These are some of the targets that this big gun line of credit shoots for. Now, what would you not want to use the line of credit for? Okay, you would not want to use it for something that has no ability to earn you money. Like, I am not a proponent of going out and buying a personal car that you're going to drive and use your line of credit for that, because that's not making you money, right? You're trying to find a way to earn more money than you're paying in interest. The bottom line is that access to a life insurance line of credit puts you in the position of the bank. And I'm going to explain to you why you want to be in the position of a bank, because banks do really, really well, and you want to be in that position. Now, here's a picture that I absolutely love. This is it's an old picture of a bank where you could see right there on the picture, that's what the bank was paying you when you deposit money into a checking account. And when you went to get a loan, they were charging you 4.2 on an equity line. So they're paying you out 2.5 on checking, charging you 4.2. So the question I have for you guys, is the bank making 1.7%? How many of you guys think the banks are making 1.7% on this deal? Anybody? I don't see any hands going up. That's good, because no, they're not making 1.7%. They don't get to have a big fountain, and they don't get to have the biggest buildings by making 1.7%, okay? That's not how it works. So just taking a look at this from a financial calculator, if you put in negative 2.5 present value, 4.2 future value, 0 payments over 1 year, the bank is actually making a 68% rate of return. And you might wonder, how are they doing that? Well, it's because they're not lending out their own money, okay? They're lending out their depositors' money, and this is exactly what you guys will be doing. You're not lending your own money. So basically, You are the bank. That's the position I want to put you in. And you pay interest to the insurance company for the use of their money. Let's just say you're paying them 6% and you've put it into a private lending deal to earn 12%. This is super simple, but if you're paying 6 and you're making 12, anybody have a guess how much return you're making on your capital? Somebody said it. Who said it over there? You got it? That's absolutely correct. You're making 100%. So you put in -6 present value, 12 future value, 0 payment over 1 year. It's a 100% return. So that is the way that you can use your money in more places at once. You've got to have your money working super hard, especially in this particular environment. So the way it works is that you're earning dividends because we only use mutually owned companies to do this, and they pay a dividend. So that is growing inside your policy, and then you're also using your big gun to take loans against your cash value, and when you repay it, the internal balance has continued to compound. So this little screen here captures a lot. It has the loan being paid, and then those steps up are the repayment. And you can see that is the power of how this bulletproof collateral works, okay? Your investment does not stop your line of credit from increasing. One of the simplest ways to understand this is to compare it to a home equity line of credit, because I'm pretty sure all of you guys understand how a home equity line of credit works. And I think that it's the most common similar tool to what I'm doing. So with a home equity line of credit, the credit line amount is fixed. And with a life insurance line of credit, the credit line increases every time you make an additional deposit, right? With a home equity line, home equity is the collateral. Okay, so it's not the total value of your house, it's however much equity you have in your house. And with a life insurance line of credit, the cash value is the collateral. It's not the face value. So I want you guys to understand really importantly that if you have $1 million policy, for example, that's just the most common one, you can't get $1 million line of credit. But if you have $1 million policy and you've been overfunding it and really creating a cash focus on the accumulation in that, you're going to have equity in that policy, and that equity is what they allow you to tap into to be able to take loans against. So that is the cash value. And basically with the home equity line of credit, one of the things that's a drag about it, if you were using an equity line from your home and you were using it for fix and flipping, that use impacts your credit score. It affects your debt to income ratio. I don't know if a lot of people talk about this, but banks look at that and they go, oh yeah, your score is going down if you use your home equity line of credit to make an investment. With a life insurance line of credit, it does not impact your credit score. So that is actually something that is really important. There's zero earning potential. Your home equity line doesn't gain you or grow money internally. And you do have growth through dividends in a life insurance line of credit. And finally, your home value can decrease. Obviously, I mean, it hasn't happened a lot lately, but if you remember 2008 and 2009, we had a lot of home values going way down. And with a life insurance line of credit, your line of credit never decreases. Home equity lines of credit are difficult to get. Okay, there's just no question about it. You have to turn in your full financial picture. You have to turn in your tax returns. You have to have your house appraised. I call it a financial colonoscopy, okay? It's like you have to go absolutely nuts to get your home equity line of credit and to get it in, especially to get it increased. And life insurance lines of credit are easy to get. So that's the big comparison between the two. I hope that helps really kind of explain the differences between a home equity line of credit and what I work with in the life insurance line of credit. And I have 3 different ways that I design these things. And I call them my different funding designs. One of them is a crock pot. I just made these terms up because I like to help people understand. This is microwave and a hybrid. So crock pot, microwave, and hybrid. So what is the crock pot design? Well, that's where you put in an equal funding for all years. And this is somebody who wants to systematically store money, right? With this particular style, you have a couple of things that are required. I call them your have-tos. And you have the optional want-to money that you're putting in every year, okay? So for year one, there would be a maximum. And then for year two, there would be a cap. So you would put in however much money you want in year one into one of these things. And then year two, you have a cap and a floor. And like I said earlier, you have this catch-up provision. And that means if you don't fully fund it in year two, you can make it up in year three. So that is the crock pot design. The next one that I do is called the microwave. That's for people who are really wanting to just slam. They just had a maximum initial funding for high early cash value, and then they want to get as much money in as possible initially. And I have people who do that who just sold a property or just had a big windfall. And the thing with this is that the future years are limited to the minimum funding. So there is some constraint on how much you can put in the future years with the microwave design. And this is great for people who have money sitting on the sidelines or just had a deal close. And the way it works is that you have this same have-to minimum, but you just cram it full with a large lump sum payment the first year, and then you make up the rest. So let's just say, throwing numbers to it, you might put $100,000 in the first year, and then you have a $20,000 minimum going on after that you have to do for at least 7 years for the thing to be considered life insurance. Okay, so the hybrid design is the third one, and it really is cool because it blends the best of both worlds. So it blends the crock pot and the microwave to boost initial cash value, but it provides ongoing funding flexibility. So this kind of maximizes my bulletproof wealth strategy, combining the best of both worlds. And here's what it looks like. So you have this same minimum, and then you have the lump sum going in, but it's not as much lump sum as the microwave was. And then you have year two and on, you have this same cap, floor, and catch-up provision. So that is how this works. I'm going to show an example. Here is one example. So guys, don't look at these numbers and think, oh my gosh, I have to do this, okay? This is not required, but this is where a client came to me and was like, okay, I would like to have an initial $100,000 line of credit right off the bat, okay? So this is what it looks like. So it has a minimum required amount of $26,958. It has a lump sum of $108,000 that they put in for a total initial funding of $135,000. Now, the way it works is that this creates this line of credit, which is the big gun on the tank, of $100,337, okay? So that is the design I did on a 40-year-old male creating a $2.8 million life insurance policy. So that gives you guys an idea of how this works. But I want you to take a look. You don't have access to all $135,000 because some of the money had to go towards purchasing the asset, and it will be with you forever. So one of the great things that I love about this is that starting year 4, you have net cash on cash positive inside the policy. So if you look at this particular design, you put in $50,000, but that year it grew by $53,892. So once you get to that 4th year, you've overcome the inertia of starting your own privatized banking system, and now every penny you put in is available and more to be able to borrow out, to be able to do your investing. And by the time you hit around year 8, your policy is fully capitalized. And in this case, your total funding was $485,000, and you have $491,000 now in there. So it just keeps going from here. So if you take a look at this, there's no premiums that you can put in past age 67. So there's a cumulative premium outlay at age 67 of $1,435,000, but it has grown internally, tax advantage, to $2.8 million. All right? Now, this is not the only place they've been using their money, because they can also use it as a line of credit. And in terms of this tax-free retirement income, this is where it really gets good, because just $2,817,000 turns into $186,264 of tax-free retirement income, never paying a penny of tax for the rest of their life. And the way this looks is that it goes all the way down to age 90, and it's still providing a death benefit of $778,000 after the $4.6 million is paid off. So it really is an amazing tax-free retirement situation. And that's, by the way, at age 90. And there you can see the $4.6 million, and that is the escape hatch on the tank, by the way. So at the beginning of this talk, I told you guys that your money needs to be working in at least 3 places at the same time, right? So what are those 3 places? Well, number 1 place is that you've got guaranteed cash value buildup. Okay. Number 2 is that you have a big gun, which is serving as collateral to put into your other investments. And the third thing is the escape hatch, which is you've got this life insurance protection for family legacy. So all of that encompassed is your privatized bank. And that is one of the key elements of my Bulletproof Wealth strategy. And so another component of my Bulletproof Wealth strategy is the machine gun, right? And that is your option to convert and create a larger bank in the future. And that is handled through convertible term insurance, right? So convertible term insurance is super important to have as a part of this overall strategy, because it gives you the option to expand your banking capacity whenever you want to, and it guarantees your health rating on conversion. So that means that you can lock in right now your ability to purchase this in the future and guarantee that you will be able to do it when you're ready. I just had a client today, got approved at the best rating for a $10 million policy. I was super excited about it. And he is going to be locking his health in so that he can convert that over time as he has capacity to save money. And this also maximizes your legacy. So that is the second thing in my Bulletproof Wealth system. And the final thing is income protection. This is what I had, you guys. It is long-term disability insurance. And this is exactly what allowed me to go back to school and get all of those different financial designations and pivot and change careers. And this provides monthly income, and it can cover your own occupation, and it stays with you even if you change jobs. And some statistics about this that are kind of amazing are about 25% of the people entering the workforce today, this is from Social Security, will become disabled before reaching age 67, right? Do you think people have these policies? No, they don't. 65% of employees have no long-term disability insurance. So I was just super thankful that I was one of the 35% that did have it. Otherwise, I would not be standing here today teaching you guys about this, because I wouldn't know. That is the 3 different components of my Bulletproof Wealth system. So I want to wrap this up and tell you guys a little story about my parents. This is my mom and dad, and I lost both my mom and dad about 3 years ago. It was within 2 months of each other. My dad had ALS, and my mom passed away shortly after that from a stroke. And they were great people. My dad was an entrepreneur. He ran a small business his whole life. It was a farm machinery dealership in Nebraska. And the thing with him is that they saved money their whole life and put it in the stock market, right? And when it came to retirement, they did not want to pull money out of their retirement plan to live on, because he didn't want to pay the taxes on it. because it was this whole thing where you were deferring taxes to the future. Well, you're also deferring taxes to an unknown tax rate, by the way, right? You have no idea how much they're going to charge you when you take the money back out of those qualified retirement plans. So I just got to see this train wreck play out in real time. And it was not pretty, you guys. It was not pretty. They just wanted to live off their Social Security, wouldn't pull money out, and then he would only pull out the required minimum distributions. And it was something that once I saw how that all worked, I was like, man, there just has to be a better way. I don't want people to go through what my parents had to go through in retirement. And anyways, I have a vision for your tank. If your tank is your wealth, right? I have a vision for your future of what your tank would look like. And this is not it. Okay, I do not want your tank to look like this in the future. So your tank needs to be agile. It needs to have a very big, powerful gun, right? It needs to be able to be future-proof. It needs to be recession resistant. It needs to be tax advantaged. This is my future vision for your tank, right? This is what I want you guys to have in the future. And this is why I created my Bulletproof Wealth System. So I will leave you guys with this. Everybody is saying, hey, put your money into a bank, and then when you find an investment, take the money out of the bank and put it into the investment, right? But that's, your money's working at one place at a time. And what I'm telling you guys is to put your money through life insurance first, as much as you can, and let it grow and compound forever. And then when you find an investment opportunity, you borrow against that cash value to put into the investment, thereby having your money work at 3 places at the same time. So I'm Tom Lonnie. Thank you very much.